The ratings agency has voiced concerns over the government's ability to help stunted economic growth. Joining us now to talk about the rationale in greater detail is Gene Fang. He's the Associate Managing Director, Sovereign Risk Group at Moody's Investor Services, who joins us from Singapore. And of course, Ida also joins in on this conversation. But Gene, may I, just an opening thought, is this a bit of a course correction to the step that you took in 2017? Because the rationale and therefore, what's the key reason why you've done this?
Sure. Well, I think in 2017, when we upgraded the rating to Baa2, we did have expectations that in the medium to long term, we would begin to see some moderation in the overall debt burden for the economy. Currently, India is at about 67% of government debt to GDP. And we were looking at a potential gradual moderation in that number. I think the negative outlook reflects the fact that there could be some challenging conditions up ahead, which would either limit that moderation or indeed potentially lead to a growth in overall debt to GDP.
Gene, good morning. This is Ida joining the conversation. Let me get to the crux of what you're saying in your ratings rationale or the release that you put out this morning. Essentially, you're arguing, and your economics division has report, that the slowdown we're facing is going to be long-lasting. But to be able to make that judgment, you have to get to the underlying drivers of that slowdown. Can you run us through what you see as the aspects of the slowdown which will be tough to reverse?
Sure. I mean, I think a couple factors that we cited include weakness in the agricultural sector, employment outcomes that have been disappointing, as well as the stress that we're seeing in the non-bank financial sector right now, which could lead to a greater credit crunch going forward. I think those are the factors that are that raise the risk that we will see what you mentioned, lower for longer growth, rather than a more rapid recovery from the current slowdown.
Gene, there has been a lot done to correct the cyclical aspects of this slowdown. We've had 135 basis points in rate cuts. The government, as you mentioned in your note as well, has tried to address rural incomes through a cash giveout, which is a first for us. Are you saying that you expect the effectiveness of those policies to be weak, even on the cyclical aspects of the slowdown?
Well, we do think those policies will have an effect, and we do incorporate those into our outlook for growth into next year. And we do expect a slight rebound in real GDP growth to 6.6%. But at the same time, we think that there are risks that that stimulus won't be enough, and that there are more structural issues at play here, which will be harder to adjust for, and that could lead us to that lower for longer type of growth cycle.
Gene, in 2017, you had raised a couple of aspects which you were hopeful will lead to higher growth in the economy. GST, a new monetary policy framework, measures to check the banking system's bad loan, demonetization, incidentally, it's the third anniversary or the third year since demonetization, and others like Aadhaar, etc. Again, have those not played out the way you had expected them to?
I think we've seen a good deal of reform, and the effectiveness of the reform may have been a little bit more mixed in its results. So to some extent, we think GST was a great reform to take. In execution, it hasn't really led to a broadening of the tax base as we would have expected. And I think that, partly points to some of the challenges of reform in the economy, but put simply, I think that some of the reforms that we've seen have been, they've taken longer to implement and take their full effect. And that probably was not expected in when we did the upgrade.
All right. If I can just come to the government finances part, Gene. So, last year we missed the stated fiscal deficit target. We also stretched out the timeline over which we intend to come down to 3% for the central government fiscal deficit. This year, the government has not admitted that it's going to miss its fiscal deficit target, but it looks like a challenging task. What's your perspective on government finances, central but also center plus state, if you're looking at those?
Yeah, we do look at center plus state, and we do think that there's a risk that the government will miss their fiscal target. I think our expectation is for about 3.7% deficit. Part of that is driven by the slowdown in the economy as well. But I think that our medium-term view is that overall, the fiscal deficits are important insofar as they help bring that overall debt trajectory down. So yes, our view is that we don't necessarily focus so much on individual targets, but the ability of the government in the longer run to show a pattern of controlling that fiscal deficit, which will translate into a lower debt burden over time.
All right. Any thoughts at all, although it's early days yet, but, there has been a lot of pressure on the states as far as finances is concerned. There are concerns that is leading to a slowdown in capital expenditure, particularly at the state level. Do you have a sense of whether the weakness in government finances is sort of worsening the slowdown a bit?
Well, I think you mentioned investment, and private sector investment has been disappointing, and it has been disappointing for a while. That's not necessarily a new part of in our outlook. I think we focused more in our outlook around weaknesses in consumption. So I think if your question was towards private sector investment, I think that has remained probably a little bit weaker than we would have liked, but that's been in the background for a while.
Gene, one question in the statement that you've written, or William Foster, the vice president of your risk group, has said that the financial stress in the rural areas and low job creation calls into question how effective the government is addressing economic sluggishness. How much weightage did you give to the recent spate of measures that the government has taken in trying to revive the economy?
Well, I think we have taken those into account. As I mentioned earlier, we do think that the steps the government has taken to stimulate the economy will begin to take effect next year, and those are baked into our forecast for next year. But I think the more structural issues in the rural sector and in the labor market may require more difficult reforms around land and labor in order to fully address. And I think when we look at the more long-term challenges to growth, I think those sort of structural issues take a slightly larger weight.